Thank you for checking out Philman Ollap and Associates Municipal Market Update for the week of March 15th, 2021. My name is Adam Bauer, and I serve as CEO and President of Philman Ollap and Associates. For our last two recordings, I spent a significant amount of time focused on inflation and how we have signs of that in the economy, thus that's impacting bond yields. And that really continues to be the focus. Some of the things have changed though. We've continued to see treasuries remain high, and we've seen municipals not increase as much as they were, and in some cases even decreasing a bit. So certainly a positive sign for municipal market issuers, and it'll be interesting to see what's next, but let's walk through what we've seen for the last 2 weeks. On this chart, that's the MMD curve going from years 1 through year 30. Tan or gray bars represent the range of interest rates for each one of those maturities. You're probably noticing that red line. That red line is interest rates as of 3/12/2021. And you're probably noticing, at least in year one, we're at near absolute lows. So here, a 1-year maturity has a 0.06 yield. Just that is very, very low. And when you look at those bar charts, you can see it's been over 3% at times for that 1-year maturity. And this is just going back to 2005. So we are at very, very low rates. And what you probably also noticing, that red line is not at those absolute lows for a lot of the maturities. I mean, you just go out to year 5 and all of a sudden that red line starts to lift off the bottom of those bar charts. So in the early maturities, we have very, very low interest rates. In the longer maturities, we've seen some increases, but they're still very low. What I think this graph is telling us is investors are building in some inflation. When it's very low, they know they're likely to not be impacted too much by inflation, but every year they go out, they are very likely to have the inflation erode their earnings. If you recall, in August, in one of our last MMUs, I talked about the FOMC policy allowing for inflation to be more than 2% to make up for years where it's below, where I think a lot of investors had viewed 2% as the ceiling. So now investors have to build that in their analysis when they're loaning for longer term. And then also all the stimulus that we've seen in the economy, all those things are likely leading to some inflation concerns by investors. On this chart, we're showing the yield curve for 3 different points in time. And that red line represents 5 years ago. And that's probably a pretty typical looking yield curve. And then we go 1 year ago. And so that's that black line. And keep in mind, this is just before the pandemic really was on everyone's radar, but very flat. So investors were not requiring much more yield to go long. So inflation was not a focus of theirs at the time. And now you see currently, you see that it looks like more like the first 10 years, it's kind of a steeper climb, and it tapers off from there. But that's where investors are saying, if we're going to lend you beyond a very short period of time, we are going to require more yield for doing so. This is the inflows into municipal bond funds. And I've talked to this a lot about being the demand for bonds. And so if you have more demand and a similar amount of supply, you have downward pressure on interest rates. Talked to you a lot of times what happened last March, just about a year ago. But go to the far right of this table. You see a little red blip. That means money flowed out of the municipal bond funds. And that is a concerning sign. It's a concerning sign if you're concerned about interest rates rising in municipal credits. And so what we want to do is monitor that and see if that continues. If that's the only blip we see and we continue to see green bars going forward, then probably not too much to worry about. But if this is a trend and investors are saying they want to invest in other assets versus municipal bonds, that could certainly mean we have less demand, and then interest rates may increase at a greater pace. So when I speak with you again in 2 weeks, we should really focus on that and see what's taking place. Now here is the supply. So supply demand, I talked a bit about the demand. We've had a reasonable amount of debt issuances the last few weeks. If you go back all the way to that 2/8/2021 timeframe, we're getting very close to 2020 issuance levels. And 2020 issuance levels were considered a high volume year. So the fact that we're getting close to that and then even have some money coming out of the municipal bond funds certainly could be some upward pressure on rates and maybe some of what we saw in our increase lately. Now here, this was a chart that I first presented to you when I said, I think we're seeing some signs of inflation, but we had not seen it in municipal rates yet. And then the next MMU, I'm showing you, well, what we thought might happen actually did happen, and it happened very quickly. And that's that red line shooting up. And so essentially what happened was treasuries had gone up, but municipals had not followed immediately. But then they did, and they kind of caught up in a big way. But now that's tapered off and they've even declined. So treasuries, you can see that black line continue to go up a bit, but now municipals have continued to decline a bit after an immediate kind of aggressive increase. More to come on this. This is a slide I'm going to continue showing you. I think it's important, and it's going to be important to help give us a gauge of what's going on with municipal rates going forward and how they compare to treasuries. Now, economic data, here's things that a lot of municipal investors will be watching. And I think any of these come in as in an unexpected fashion will certainly have an impact on the municipal market. Now, our last slide is Philman Roll-Up and Associates Registered Municipal Advisors. I'm very happy to show some additional team members on there. And I encourage you to reach out to any one of them for specifics on deals in the market or any other questions that you may have. But thank you for your time. Appreciate you checking out this on such a frequent basis. And I look forward to talking with you again in 2 weeks.